The COMEX just reported something I have not seen in 10 years. Silver inventories. The physical silver sitting in COMEX-approved vaults that is actually available for delivery just hit a 10-year low. 10 years. And here is what makes this truly alarming. The price barely moved. The mainstream financial press hasn't touched it. Your broker hasn't called you. Nobody is talking about this, which means either the market is completely broken, and I don't think it's broken, or there is a delay between when this kind of signal appears and when the market responds to it. And that delay is a window that closes. I'm going to spend the next 12 minutes explaining exactly what these inventory numbers mean, why they matter, and most importantly, what has happened historically every single time COMEX silver inventories have reached a level like this. Because the history here is something every silver investor needs to know. Stay with me. I'm the Silver Rabbi. I track precious metals markets every single day. I've been watching the COMEX inventory data for years. And when I looked at the numbers this morning, I knew immediately this video needed to happen today, not next week. Let's get into it. First, let me make sure everyone understands what we're talking about, because the word COMEX gets thrown around a lot, and not everyone knows what it actually means. The COMEX, the commodity exchange, is the primary marketplace in the United States where silver futures contracts are traded. When you hear the silver price is $79 today, that price is largely set by COMEX trading. It is the global benchmark. The COMEX maintains physical silver in approved warehouses to back its futures contracts. That silver inventory is split into two categories: eligible silver, silver stored in the vaults but not committed for delivery, and registered silver, silver specifically earmarked and available to be physically delivered to someone who holds a futures contract and actually wants the metal. The registered number is the only one that matters for our conversation today, because that is the silver that is genuinely available to back the paper promises trading on the exchange. Everything else is theoretical. Registered COMEX silver right now stands at approximately 76.88 million ounces. That is the lowest reading in a decade. And I want to put that number in context for you, because the raw figure means nothing until you understand what it sits next to. Global silver consumption runs at roughly 1 billion ounces per year. That is approximately 83 million ounces a month, about 2.7 million ounces per day. The entire registered COMEX inventory, every single ounce that could actually be delivered against a futures contract, represents less than 29 days of global silver demand. That number is not a typo. That is the real number. Now here is where the story gets genuinely alarming, and I want you to really listen to what I'm about to say, because most people who trade silver, even experienced investors, do not fully understand the implications of this number. The open interest on COMEX silver futures right now represents approximately 575 million ounces of silver. That is the total paper exposure sitting on the exchange right now. Compare that to the 76.88 million ounces of registered physical silver. That means the paper to physical ratio on the COMEX right now is approximately 7.6 to 1. For every single ounce of silver that could actually be delivered, there are 7.5 paper ounces that could theoretically demand it. The coverage ratio stands at just 13.2%. the sixth consecutive period below the 15% stress threshold that exchange analysts themselves identify as the danger zone. The warehouse does not have enough silver to fill the contracts written against it. Now, I'm going to immediately tell you why this doesn't cause a crisis every single day. The answer is, almost nobody actually demands delivery. The overwhelming majority of COMEX futures contracts are cash settled. Most of the people and institutions trading silver futures are speculators, hedgers, and financial firms. They have no interest in taking physical delivery of 5,000-ounce silver bars. They want price exposure, not metal. So the system works, as long as everyone keeps playing the paper game. But here is what history teaches us. The system keeps working, right up until the moment it doesn't. And the thing that breaks the paper game is always the same. A sufficient number of contract holders deciding simultaneously that they want the metal, not the cash. When that happens at a ratio of 7.6 to 1, the math becomes catastrophic for the exchange. Let me take you through what happened the last 3 times COMEX silver inventories dropped to levels like this. The first comparison, 1979 to 1980. COMEX silver inventories came under severe pressure as Nelson Bunker Hunt and William Herbert Hunt accumulated an estimated 1/3 of the world's privately held silver supply. The exchange's registered inventory couldn't keep pace with delivery demands. The COMEX's response? They changed the rules. January 22, 1980, they imposed liquidation-only trading. Only sellers were allowed. Silver crashed from nearly $50 to under $11 in a matter of weeks. What this tells you? When COMEX inventory stress becomes severe enough, the exchange itself becomes a force in the market. They will act to protect the system. That action can be violent and sudden. The second comparison, 2011. Silver ran from roughly $18 to nearly $50 over approximately 8 months. COMEX raised margin requirements 5 times in 9 trading days. Physical silver premiums spiked as buyers scrambled for metal. The price then crashed back below $30 within weeks. Again, the response to physical stress was not allowing price discovery to work freely. It was rule changes designed to cool the market. This is the pattern. The third comparison, early 2021. The WallStreetSilver Reddit movement pushed for coordinated physical silver buying. In a matter of days, retail buyers cleared physical silver from major dealers entirely. Premiums on American Silver Eagles went from $2 to $3 over spot to $8 to $10 over spot. The spot price barely moved. The physical market went completely berserk. That divergence between paper price and physical market reality is exactly the condition we are seeing signs of right now. Except the current inventory level is lower than it was when that happened. Here is what separates the current situation from the previous ones I just described. All 3 of those historical episodes were driven primarily by speculative activity. The underlying industrial demand picture was not the same as it is today. According to the Silver Institute's most recent data, global silver demand reached 1.12 billion ounces in 2025. Industrial demand alone accounted for over 680 million ounces, a new all-time record. Solar panel manufacturing alone consumed a record level of silver, up multiple % from the year before. Meanwhile, mining supply came in at approximately 1.05 billion ounces. That is a deficit of 95 million ounces. The world consumed more silver than it mined last year, and the year before that, and the year before that, and the year before that, and the year before that. 5 consecutive years. And 2026 is forecast to be the 6th. The Hunt brothers created an artificial inventory stress through concentrated accumulation. What we are seeing now is a natural inventory stress driven by real-world industrial consumption that is genuinely exceeding supply. That is a fundamentally different animal. It cannot be resolved by changing the rules. It can only be resolved by higher prices. That is why this COMEX inventory reading against this specific demand backdrop is more significant than the same reading would have been in 1979 or 2011 or 2021. The conditions that got us here are structural. They don't reverse overnight. And the market has not priced that in yet. I want to be straight with you about what I think happens from here. Not one outcome, 3 scenarios. Because nobody knows which one plays out, but you should know all 3. Scenario 1. The system manages it. New supply comes to market, inventories stabilize, the deficit narrows, price rises gradually but no explosive move. I'd say this has maybe a 35% probability given where we are. Scenario 2, a slow squeeze. Inventory continues declining. Remember, we already saw 1.9 million ounces withdrawn from registered inventory in just the last 30 days, and the May 2026 delivery cycle is approaching with 48,370 contracts still open, representing 241 million ounces of potential demand against 76 million ounces available. The registered number drops to critical levels. The COMEX responds with higher margin requirements or rule changes. Price moves significantly, 30, 40, 50% over 6 to 12 months. Messy, volatile, but ultimately a repricing toward fundamentals. This is my base case, roughly 50% probability. Scenario 3, a disorderly event. An unexpected trigger creates a cascade. Paper price and physical price decouple. Premiums on physical silver go to extraordinary levels. Moves that would normally take years happen in weeks. This is not theoretical. In January 2026 alone, 33.45 million ounces were withdrawn from registered inventory in a single week, representing 26% of deliverable silver vanishing in 7 days. I give a repeat of that type of event, at this inventory level, a 15% probability. Low, but not negligible. And the asymmetry matters. If scenario 3 happens and you're not positioned at all, the regret is severe. There is a principle in Jewish law called chazaka. It describes the presumption that an established pattern continues until proven otherwise. If something has been one way for long enough, you treat it as if it will remain that way, unless and until the evidence changes. The established pattern for the past 5 years has been silver deficits, declining COMEX inventory, rising industrial demand, and a price that has not fully reflected any of those realities. Many silver investors have given up waiting for it to resolve. They've concluded the market is broken and nothing will ever change. I understand that frustration. I've felt it myself. But chazaka cuts both ways. The pattern of suppression has been one pattern. The underlying pattern of physical depletion is another. And in commodity markets, physical reality always wins, eventually. Not quickly, not on a schedule, but eventually. Today's inventory number is not proof that the resolution is tomorrow. It is a signal. a clear, data-backed signal that the tension between paper price and physical reality is intensifying. A 13.2% coverage ratio, a 7.6 to 1 paper to physical leverage, 6 consecutive deficit years, 762 million ounces drawn from global stockpiles since 2021. Every time conditions like this have materialized before, something significant has followed. What you do with that information is your decision. I am not your financial advisor. I am a student of this market who shares what I see. And what I see today, I thought you should know about. If this was useful, subscribe. I post every single day. Tomorrow I'm going deep on the 3 specific events in COMEX history where the paper to physical ratio reached levels like this, and what the price did in the weeks that followed. Don't miss it. I'm the Silver Rabbi. Stay wise. Stay protected. I'll see you tomorrow.